morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyce-Noe with my co-host Kevin Casey, and today we are joined by Tracey King, who is the COO of Partners Credit. COO, not to be confused with, something other than a very important person at Partners Credit. And
But
just
she
start out,
probably will be someday.
I just want to say, ready, Kevin? Happy birthday
Oh
to
God.
Happy
No.
birthday to you. Happy
Yeah.
birthday.
Birthday, dear Tracey.
Happy birthday
birthday
to
to
you.
you.
Thank you.
Okay, just for the record, I
She's
texted
21.
him prior to that and I said, "You'll sing with me, right?" And he said, "Yes."
Oh yeah. So that's what the
Clearly,
text was about.
yes, it was a big fat lie, obviously.
I did. And see, the problem with Zoom is it only allows one person to speak, so we don't speak over each other. And so even though I was singing, you had the mic according to Zoom.
Okay. First of all, I've been accused of talking over people on this show so many times that I cannot even imagine that is true. So that's
It's just one's on video. That's it doesn't erase the other person.
That's a setting. I'm telling you, I have everyone on here the whole time. So I don't have.
So do I, but I think when you watch it, it's different if you're not a panelist.
I don't know. Check.
I appreciate it.
Anyway,
I'm at the age
on your birthday.
I'm at the age now where people make the jokes about being younger than I am. So you are getting older when people say happy 29.
That is so rude. Rude, I say. And also, by the way, happy freaking New Year.
Happy
New Year, everyone. Holy moly.
Yeah, wow, we made it.
God, that 2024 is behind us. I am so happy. So, with that being said, it is a very, very busy week this week. I texted Kevin yesterday. I'm like, how is it already jobs week? I mean, isn't that crazy?
I feel this every week, Audrey. That's why they call it Jobs Week. It's every week.
Month, you dork. Okay, so we had JOLTS today, which came in a little hotter than expected on the surface, but if you took a little dive into it, not as great. And also just remember with JOLTS, I didn't realize that it was a Bureau of Labor Statistics number. So that in mind, immediately it goes screech.
When I use surprise, it's a surprising number. It's a jolt number. Come on, it's supposed to jolt you.
Right. Okay. With that being said, there is some conversation about whether or not some of those jobs or many of those jobs might be double counted since COVID, since people are able to work remotely. So maybe they're being listed in more than one place. And that isn't necessarily an accurate description of what's going on in the job market. But do not fear, because tomorrow we will have ADP, where they are expecting 140,000 job creations. Tomorrow we will also have the Fed meeting minutes from the 12/18 from the December 18th meeting, where they did a little alteration to their projections for what they were going to do next year, their cuts. So it'll be really interesting to see how that goes. And then we have a 30-year bond auction. And tomorrow, this week we have 119 billion, that's with a B, dollars in treasury auctions. 119 billion. So that would be the government going, show me some money, honey. Okay. With all that being said, on Friday, we will have BLS. And we all know how I feel about that, but they are projecting 154,000 job creations and for the unemployment rate to stay the same at 4.2%. So whether all that happens, we'll see, because it's been all over the place lately.
All over. I was quite surprised by the JOLTS number today, but
I know. He texted me late last night something, and we'll see how I do today. I'm not feeling great and my head is a little foggy, so it's I was like, what did that mean? Anyway, I think the projections are rough. It's hard to make a projection these days, and I think it's interesting because things change all the time, and we have a few projections to talk about this week for the year. But looking back at last year, they just kept revising things, right? So, all you can do is see, okay, what just happened? And now we're going to adjust. So the whole point of that is, if I could create a point in my brain today, is it is 2025. We are 2+ years into the downturn in the rates and the inflation, and all that has been impacting our businesses. And it is way past time to stop worrying about the rates. If the rates go up, the rates go down, whatever. So I know I've talked about this a lot, but it is really something to take note of. Most of my business last year was not conventional. Oh my God, what's the rate financing? It just wasn't. And that saved me. So I finally listened to all the stuff I've been telling everyone else for the last couple of years and started doing it myself. And guess what? It was transformational. So I would encourage everyone, we're going to be talking about that a lot this year too. What can you do besides Fannie, Freddie, FHA? Because those credit boxes just keep getting smaller and smaller.
Mhm.
That doesn't mean that people don't need housing. And we have
So you're
1.9
saying go get another coloring book?
coloring book. Yes, yes. Okay, see, I told you I'm a little slow. I'm like, hang on, wait, what does that mean? Anyway, with all that being said, again, don't use the rate as an excuse to not do business. Don't do it. It's ridiculous. People need housing. They need to buy investment properties. They need to do loans. Offer them alternatives. And again, at this point, Fannie and Freddie has made a situation where, okay, maybe they're the best if you're doing a conventional 30-year fixed, refinance, not even refinance, purchase, right? Maybe. But if you're doing an investment property, it is very possible that a non-QM loan is going to be a better price for your borrower or a better deal for
Mhm.
your borrower. And if you can get through the whole prepay option or you can't ever live in it as an owner occupied with this loan, that might be your best bet. And so again,
Yep.
this is like re-educating your clients, getting out of your comfort zone and doing things different. I know I keep beating that drum. It could not be said enough. It's so, so important. So with all that being said, I kept asking Tracey last year because I love her so much and I just love when you're here and you're always such a wealth of information. I'm like, Tracey, come be on the show. And you're like, oh, there's nothing to talk about. I'm like, I called her last week and I'm like, that's it. I'm not just you're Tuesday, you're it. So we have some changes with credit. Most obvious is the pricing, but also some other things to talk about as well. So let's start with the pricing on credit this year. So one more time, FICO has increased the price of a credit report.
Yeah. But you know what? They did something pretty smart, which they did a delayed kind of reveal of this before, where when they increased what their pricing was going to go up, they made that public so that everyone would see that anything other than that is also the bureau. So when the first huge increase that we had happened, everyone was like, FICO, FICO, FICO. This is all FICO. Until FICO came out and said, hey, PS, we were only this part of it. The other 50% of this was the bureaus basically matching what we increased. So whoever did their PR for that was pretty smart, because they're saying you can't just, beat us up, even though I feel like everyone just beats up us.
Well, okay, so let's just talk about that for a minute. So you at Partners, are you making a lot more money now because
Oh yeah, they have to be, Audrey,
I mean, you
because
must be
FICO raised
totally in it.
theirs,
Is
the
it all
bureaus raised theirs, therefore Partners has to raise theirs.
Well,
Yeah.
we have to,
Making
right?
tons more money.
The question is, right, it becomes our profit is smaller for sure. Our profit margins have shrunk along with everybody else, because as the pricing's gone up, we don't get to negotiate with the bureaus or with FICO, but our customers sure as heck come and negotiate with us. We were
Right.
just talking, my last 6 weeks have been, we put out our pricing letters and people come back and they shop. It's a business. I understand that. But it is very difficult because it's conversation after conversation of how can we squeeze this more? How can we squeeze this more? And, love everyone out there. But at some point, you also have to look at what your process is. And if you're
Yep.
unwilling to change that, the pricing is going to be what the pricing is. I cannot make you close more loans. I cannot make things stick more and have a better pull-through rate. I can't do that. I can look at some of your data and how you are pulling and who's doing what and who's differing and put some guardrails around that. But it does become very, very challenging. So are we making more money? We have more revenue for sure, because that's just math. That's just the way things go. But the margins, it's a
Are
very,
tighter.
very tricky thing.
Yeah.
So when you ask if someone's making more money, we're looking at the net. So the answer is no, because you're squeezed, right?
Yeah.
So it's, yeah, again, revenue streams are not the question. It is, are you actually making more money? And the money is not going to you at Partners or any of the credit providers. It's going to the bureaus, it's going to FICO. Is that correct?
Yeah. Yeah, I mean, there's so many other things too. If you get a liens and judgments report on your credit report, that's an addendum to what that data. So that's a third party data provider. We have to pay that person.
Right.
They increase their costs. So it's, you think about all the things that are included. LOS click fees oftentimes are bundled in, bureau surcharges, all of these things, you know, which people bundle in because they want it clean and nice and tidy. But you forget there are so many ancillary things that go in there, you know, TransUnion fraud, or it adds up. There's all these tiny little charges that go. And so, you know, what we're looking at, depending on what you have in your credit bundle, a joint tri-merge in the, you know, mid 100s is pretty much the standard now. And as we sent that out and everyone gasped, and they're like, you must be out of your mind, and start shopping around. And yeah, that's the norm. It's depending on how you slice it. And, you know, it is time to get creative, start looking at how many individual reports you're pulling versus joint. Are you doing flat pricing? Are you doing split pricing? You really, really do, as a company, need to take the time to start looking at, you know, the numbers kind of all end up the same on the invoice because we have to make the money to pay who we're getting the data from, but you can be creative in which how you are collecting it. So if that's coming from, you know, do you have a majority of individual versus joint? How are you being priced there? You know, you should be able to work with your credit reporting agency. And, you know, for better or for worse, I'm pretty transparent with people, where at the end of this, I'm just like, you know what? My margin on this is 2%. So I don't care. I'll show it to you and we'll go from there. And on certain products, if you're squeezing me and saying, I can't do this, you know, we had so many people that came back and they're like, I'll go out of business. I cannot have this credit report be $100 and something. You know, as a third party, what do I do with that, right? I want our customers to succeed. I want them to use us. You know, gone are the days that it's like, who can we rack in and get a good price on? And, you know, that's gone, you know, and it wasn't necessarily ever truly, truly there, but there's so much going on where now our business is truly, truly working with customers to figure this out. Anyone can undercut anyone, you know, I probably sound, you know, new year, slightly jaded. You guys are getting me on the tail end of the pricing, but really it's so much back and forth of what can you do for me? You know, here's what my vendor told me their price was. Can you do better? Sure, we all can, but that only lasts so long. And then you really need to say, are you having a conversation with your vendor on how to improve it? Not just like bring your costs down on the actual credit report. It's, are you really looking at your processes? Are you looking at how you're spending? Are you looking at different scenarios and how that could end up for you on your P&L? It's just a very different conversation than people are used to having or want to have or don't want to put the energy into having. But let's face it, we're your most expensive bill. That you have to. Just like people are doing that with the work number now, and there's lots of alternatives. People are finally kind of moving towards electronic VOAs and connecting with the banking because, you know, for so long, people are like, no, my borrower, I don't want to involve my borrower. That's too much. They're going to think it's too much. Really, no, it's just time. And I think, Audrey, you said it best at the beginning, where it's like advice we give other people, but don't take ourselves, of like, will you do the extra work and change the way you're thinking about it? You can't still wait for things to get better, wait for rates to change. That's not a way to live, and not how we, you know, well, I guess I'll wait till the car breaks down to get the oil change, or, you know, whatever it is. We have to start thinking about things differently.
Well, I think that can be said for every aspect of our business, is that we
Yeah.
have to constantly be assessing, reassessing, checking to see, is this working? What could we do differently or better? And to that end, I mean, there are a lot of things that go into a credit report that we didn't used to have to deal with. Like, what, explain to me what an LOS click fee is. I have no idea what that means. And we're being
Well,
charged
it's
for it?
super fun because your LOS that you use it charges you and they charge us. So every product that you order through us, we get a charge. Like if you click to order, so there's the credit report. Then if you go and you order a tax transcript, we get charged from your LOS as well that you are choosing to, and it's not pennies. It could
Charging
be,
extra, like, let's back up. So if I go to your website and I order a credit report there and then import it into my LOS, is that cheaper?
no, because it still has to be accessible. I think there's still like an import fee for that. But I mean, you know, at
Okay,
the end of it, depending on your volume, if you were a small business, we could probably
Uh-huh.
shave a couple bucks off of you if you just did everything direct to our website. But nobody does that anymore, really.
right. Click
But
fee.
yeah, but it can be significant. I mean, you know, $1.50, $3 on a report.
Wow. Okay, so I thought there are a couple things. Number one, so my processor, God bless him, he is, let's just say he remembers things that the average person would not remember. He would be able to access. He's unbelievable. So he decided to go back and look at the history of his refinances. And this is what he found. In 2016, he was charged $21.50 for a single person credit report. In
Yeah.
2020, he was charged $27 for a single person credit report. In 2025, he would be charged $76 for a single person credit report. And then he pointed out that for two people it'd be $130. And we're seeing, Kevin and I teach in MLS continuing ed. And so we have a lot of conversations with people in different parts of the state.
Yeah, smaller
About
shops are
what
paying a
are
lot.
you seeing? What are you doing? What are you? And one person was telling me that this very large company who we all know is charging $250. That's the amount they're disclosing on the LE for
Yeah.
credit, work number, all that stuff. And I always like to remind my clients that your company decided that you were going to pay for that verification of your employment and that they were going to offload it to the work number instead of us being able to go directly to them. And I have been going around and around with the UC system for the last week because I have somebody who started a new job. I needed to show the number of hours worked, which the work number does not reflect. And then the letters we were getting from her people it's just been a nightmare. So finally we got the recruiter to do something, but the work number was useless and, is not inexpensive and not easy to work with in all situations.
Yeah.
So again, are these systems really working? Are they effective? Are they saving time? Are they saving money? And
You know,
it's sir,
way back in the day, I remember when you wanted a verification of deposit, you had to send a form and you would mail it, and they wouldn't charge you for this fee, and the bank would
taxed it,
get this,
Kevin,
and
geez.
they would fill it out, and they would put a new stamp on it, and they would mail it back to you on their dime.
Oh,
Yeah.
wow.
Yeah. Well, and the verifications of employment, oh my God, it was a million times better because you could call an HR department or
Oh,
get a
yeah.
hold of somebody. It was then you
Or
could get
here's the best
the
one.
information that you needed and it didn't cost a fortune. Now, I would imagine there was some fraud around that, but it's easy to check. There's a phone number, call them. See, is this real? Is it not? Does it match your tax information? You know what I mean? Like,
It's super difficult, and that's something, we offer all those services and we've done manual VOEs forever and we've had that department. And then, yeah, it does become, we always pushed it because of the fraud issue. This is the one area that you're allowing your people to touch and verify. It should probably be a third party, but that's my side, whatever. But it did start to become challenging because the work number became more and more, monopolizing that part of the industry. And you had to go through there. And then the work number charges, if you want to also talk about what's gone through the roof, what that used to be comparative to what it is now, and restricting or requiring certain information and not being able to control those costs. I mean, that's been wild. But so now we're starting to see more and more. I mean, it went from us doing manual and the work number to now there's Experian Verify, VOIE, everyone's doing these cascades of different options that you can do. to kind of avoid that. But then again, it's like, we just keep adding on and adding on and adding on to simplify the process. But you know, everyone's heard of all of these different companies out there providing a service that is
They're all
tricky.
taking a piece of the pie.
And you know, for us, it's hard. I can only imagine. I was thinking about this at MBA this year, walking through the exhibitor hall. We don't do that anymore. It's too much. It's like, I can't booth babing it. It's too hard. But I walked through and I thought, what is it like to be a lender with all of these possibilities, all of these different vendors that want to work with you and say that they have the best solution? It has to be overwhelming. And so when you're looking even for like VOEs, there's probably 10 to 20 different vendors to choose from, all offering something similar. So it's very difficult. So, you know, for us, what's important is integrating with as many as possible, so that one thing we can do is eliminate you having to deal with 10 vendors, and we deal with it, and you just have that with us. And so then we can kind of confine it, put it there, give whomever you need to have access, and then you have options, but you're not trying to manage all of this. So, you know, not to be too pluggy, but that is something to think about for myself or with other vendors that you work with, is how can you manage this and consolidate this more? Is it an extra dollar for going direct, or excuse me, to go from going from direct to a third party might be slightly more expensive, but then you have to think about, what are you saving on your vendor management? So that's, again, if we're doing kind of a analysis internally, it might not work every time, but it might be something I believe you should consider.
Well, it kind of reminds me of the conversation that I've had on numerous occasions with maybe regulators about, okay, so we have all this information. Is it making everything better? Are
Yeah.
you having lower delinquency rates? Does it really translate into some sort of value for somebody? And so I think in a lot of situations, you have lenders who are afraid to not do all of the due diligence on the back end. They're afraid to not have all those reports, not have all these boxes checked, because what if there's a buyback request? What if there's an issue and they didn't do something and they're nailed to the wall? I'll go with wall.
Yep.
And then they could, you know, and they can't say, oh, we checked there. And so it is really, I think we're
Well,
at this point.
things are better in a lot of ways because things happen faster now. I mean, we can close loan in days. Well, think back in the days when things had to be hand completed. You know, when you send out a verification of employment and you had to hope that the HR person was not on vacation that week, or that, you know, they got around to it, or like when I started out of high school, I worked as a teller at a bank, and they would give us all the VODs that came in the mail that day, right? But if I was slammed because it was the end of the month or Social Security payday, and there was nothing but, you know, all these old people coming in cashing their checks all day long, I didn't have time to fill out a verification deposit. It had to wait till another couple days sometimes, and sometimes I would push it off a week or so before I filled it out.
So guess what, buddy? What happened at that point is someone who wasn't a slacker would go to the bank and say, hey, can you fill this
Yes, they would,
out?
and that saved
Sometimes
me, and
we
I'd find
drag
out
our
if they
car,
did that,
we could get
and then
that.
I wouldn't have to fill it out at all.
Yeah. So just because you were lazy and doing whatever, God knows. I mean,
Well, this is what I'll say. I'll say one thing that I have noticed is that, you know, a couple of years ago, Kevin, to your point, it did seem like everyone was like, whatever we need, let's do it. Fraud reports, prior to closing, pull a full tri-merge pre-close or LQI report, you know, all of this, liens and judgments, whatever.
Right.
I have seen the last couple of years, people modifying that a little bit.
Yeah.
Do
Makes
we
sense.
really need a tri-merge pre-close LQI report? Do we really need to do debt activity monitoring with all three bureaus? Can we do one? Can we do two? Who's looking into that? So I've been a part more of conversations with internal compliance with our lenders, really starting to question, okay, are we being overly guarded on some of these things to the point where it's wasting money? And, what can we do to modify that? So I have seen some modifications on the back end of, rather than doing a full tri-merge pre-close report, let's do one bureau, a single bureau. That can be a pretty big deal there. So I'm seeing a lot of that. And I'm seeing a lot of people kind of pull back on the whole exciting pre-approval, pre-qual with trended, reissue, all of that. Because I think a lot of people started going into that with the hopes of the trigger leads, diminishing that. And again, it's another thing that if you are in an area that's really saturated with triggers and you're losing a ton of business because of that.
Then it makes sense.
Yes, but 9 times out of 10, and this is me saying it, I don't care about the revenue, whatever, 9 times out of 10, it does not work. And it does not work well for our customers because you cannot control loan officers of how quickly they're just going to repull that credit. And they're worried of how long they wait to pull credit. And so now you have 2 credit reports that have been pulled pretty close to each other. And if you're talking about a joint tri-merge for 130, now you've got something like 260 and you're not even in underwriting yet. So it's something to think about and something to really look into and look at of, again, what are your process? What are your,
My first step when I talk to a client now is get the opt-out pre-screen completed by them. And I log it in on my calendar as to what day they did the opt-out pre-screen. Then I wait a week and then I pull credit then.
And do you think, are they waiting a week for you? I mean, that's the other part of the conversation.
It just depends on the situation. So normally if it depends how well I catch them and if I can get them to get it done as soon as possible and can we wait a week, then I will. If it's not, and there is a side benefit to waiting a week, surprisingly. Sometimes the deals blow up in between the week and I haven't even pulled credit. So therefore I've totally saved $130 because we didn't even pull credit and the deal's already blown apart. Unfortunately this Monday I pulled credit and the second I pulled it, the deal blew up, but it had nothing to do with the credit. But if I had waited one more day, I would have saved that $130.
Well, okay, so we have a couple comments in the chat. One of them is from Jenny, who said the work number is a pain with no contact information. And she just had a situation where the work number doubled the borrower's income. So they're not infallible and not great. We also have
wait. I want to know how they did that. That's a pretty good trick.
Okay, that's not going to help you for any level. It's just a mistake.
So no, it gets the ratios down and then you get better credit score.
Oh my God. So oh my God, so many things wrong with that. With all that being said, one of the things that we noticed in our conversations with LOs across the country in the last few months is that there is a trend towards LOs charging the borrowers for credit upfront. And they're telling us that they're getting no pushback at all. And that they feel like the borrowers are more committed to them when they do this because they have some skin in the game, which makes a heck of a lot of sense. So have you heard that, seen that? What are your thoughts on all that, Tracey? Because
I haven't.
I
only have one customer that has said that they are going to, but it's one of those, like, they always threaten to do it, but I haven't heard too much of it, to be really honest. I think it also depends on where you are in the line of shopping for that borrower. If you're the first person and depending on your relationship and you say, okay, we're going to charge you $130 now, they're either going to say, well, if it's cost $130, I'm not going anywhere else. Or they're going to say, the hell you are.
Okay.
And go somewhere else. It depends, I think, on their knowledge and education on it and what it looks like. So, I think it varies. And I see someone kind of put out there that they charge an upfront, but it's like a single softball. So if you're doing it to that point, that might make sense, at least to kind of see what it looks like and you're getting something from that borrower. But the majority of ours are still not collecting on the upfront.
I just think it's something to think about in this year.
Oh, yeah.
If we're looking at
going to get harder and harder, though, as well.
Looking at bottom lines. And by the way, some of the other things I'm seeing is companies who are limiting the access that LOs have to pulling credit, which
Mhm.
sometimes you need to have access to the person who can do it for you, like anytime you need it, if you're not going to actually have access. Like you can't just cut them off at all, totally from the process. But I find that again, I think to your point, you have to have a look at your processes, what is working, what isn't working, and also look at at your LOs, and are they pulling a bunch of credit and not closing loans? I
Yeah.
mean, it's really something that you have to look at, and it's a scrutiny that hasn't happened so much in the past. The other thing too is if you have an LO who is pulling credit and asking a ton of questions and creating a lot of hoopla, are they worth it? Like I think there is a look at what is an LO doing and is it effective? Is it working for your business model? Before it was like, oh, they're really nice. Oh, I really like them. Oh, they're great to have around. They're loyal. But again, when we're all in survival mode and it's getting better now, but for sure, there was a time where, okay, you can't have somebody who is just eating up resources and not producing anything. So it's definitely, I think, time for everybody to really hone their game. If you're an LO, make sure you're looking at that for yourself. Like you don't need to be told. You need to look at it and go, okay, realistically, how many times have I run a credit report versus how many times I'm closing a loan? Is it paying off? And so look at yourself first. Don't wait for somebody else to come and smack you in the head and fire you, or you know what I mean? You want to be the one who is making the changes and being self-aware enough to know, am I valuable? Right? So
Yeah.
it is, I mean, this is not easy. It's not
Yeah,
easy
no,
to look at the
I
and
do it
go,
myself. I used to just, I'd take an application, just pull credit right away, blah, 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 do all this other stuff. And now it's like, no, let's just hold on and see if this client solid first.
yeah, yes.
And
Yeah,
then even with
it's
that,
changing your mindset. Yeah.
yeah,
It's changing your habits of what
yeah,
you've done in the past. And I think that's the biggest thing. And Audrey, you hit it right there where it's not easy. Changing is very difficult. And I think that's you keep doing the same thing over and over and people are like, like I said, we can't control that the costs are going up, but there are other things we can control or look at. It just takes
mhm,
work. And are you willing to do that? Similar
yeah,
to, are you willing to work with a borrower that's not totally vanilla? You
You
can,
should.
and to your point too, Audrey, it's like you can do that. It takes extra work.
Yep.
Are you the person that's willing to do that or not? So,
yeah,
if you want to see a difference, then do the extra work and work with someone that will do it with you. I mean, that's the other thing. You have to have a willing partner, and then be willing to kind of hear what they're saying. So I always encourage those kind of difficult conversations, but there's space there for sure.
I
yeah.
do
There's
think that
three things now which I charge up front for that I would not before. So appraisal was the first one.
oh yeah.
Then credit started,
Oh,
but
yeah.
now it's paying for their insurance up front before the close of the escrow on a new purchase. Because it guarantees that they'll have the money and time for the fair plan, because they only have a few days to get that money into the fair plan. So I've just come to learn that just get it up front. That way you're sure that you got it for close.
Yeah.
And
I
they
think
don't balk. It's just crazy.
I want to push back a little bit on something because I think that we accept things in our industry as, oh, that's just the way it is. And therefore we have ever increasing costs. We have ever increasing forms to fill out, regulatory things to manage, and we lose track of, does this benefit the buyer, the borrower, and does it really help you with delinquencies and making sure you have credit worthy borrowers, and versus, oh, we just checked a box and now we're compliant. So we've had rising cost over the last number of years, and if I have to hear one more person say LO comp, I'm going to smack the crap out of them. Oof, whoops, sorry. um Sorry. See, guys, I'm sick. I have a foggy head. I'm not as clear. Okay. With that being said, I'm sick of it because its LO comp hasn't changed. It's all the other all the other costs, including but not limited to, private jets being driven by or ridden or flown by owners of IMBs. So it is not fair to put that on LOs. Let's start there. But also we need to be questioning the regulators and questioning these charges and raising a fuss. Cause I keep asking, okay, so we have had an huge, obviously, increase in the credit report fees for mortgages. Are they having them? If you're standing at Target and they offer you the credit card, are they paying 60 million times more today than they were 5 years ago or 10 years ago? And nobody can answer the question. I don't know what the answer is, but it's frustrating to me. So it is, I think we do need to be questioning. I think we do need to be pushing back, but when we're pushing back at you, that's not helping. It's pushing back at the credit
Right.
FICO, that's
Yes. And now, talking about when all of this happened a few years ago with FICO, I reached out to, is it Mark Myrtle? Mark?
McCardle.
Yes. And I reached out, who is wonderful and lovely. And I know he's been on your show, and he was very responsive to me because I said, what are you guys going to do about it? And they said, we're not involved with the bureaus in it, blah, 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 blah. So then
we always start there.
Right. But however, about 6 months ago, they did put something out that they are looking into it. Now, I haven't heard boo since then, but it is something that is very much impacting the borrower. It has to. And, I know a lot of people are looking at doing closed loan pricing where you charge minimal at the upfront and you're going to charge it at the back end for the borrower that closes. It's a little bit of, robbing Peter to pay Paul. But it is a solution that people have looked to. This is ultimately going to trickle down to the borrower, whether, they feel it or not, or however you bundle it. If it's your credit report cost or it's your overall package that you're putting together, it's there. And I hope they continue to look out for it. I mean, it's only going to get worse because at some point, everyone's very excited about Vantage and the new FICO 10T, but now you're going to have two different score models on a credit report, and that data costs money. So if you think it's going to be a cheaper option, that's not happening.
I think what we need is a new bureau that would compete with the three.
Well, that's what Vantage was.
Yeah, but they're owned by the bureaus.
I mean, it's Vantage Score was created by the bureaus to create a competitor to FICO. I mean, all of these things. You talk about a buy merge and only needing two bureaus, but that's again great ideas, but it's hard to change and make things happen. But your voice, and whether it's through your state MBA or going directly to the MBA or reaching out to the CFPB, it does make a difference. So pre-qual reports, pre-approval with trended data, that could actually be really, really great if they changed the way that you have to do a hard pull with scores. Why do you need scores if you did a pre-approval with trended and you gave a firm offer of credit? So if you were able to give a firm offer of credit, then their score could change and you're going to have to change the loan terms.
Price it without a score. That's the problem. We can't price without a score. And
but it gives you a score, a pre-approval, a pre-qual report.
Why do you need a score? I'm like, oh, okay.
On the second pull.
Oh,
so right now, a pre-qual, you have the scores, you're able to give an offer of credit, but because of the regulations, you have to then pull a hard pull credit report with scores. Right. What we're pushing for and what we're telling all of our customers to push for when they're talking to Fannie and Freddie and whomever is, how about you do a hard pull with no scores? That reduces that cost of that credit report significantly. So, then you can rid yourself of the trigger leads and all of those issues, but you're not putting yourself at risk or the borrower at risk for their score changing and when you have to pull that second report.
And you would know what the score was because you, as a loan officer, if I see someone's got no lates, they have lots of credit and good balances, low balances, then I would know that their credit scores are fine without actually having to see a credit score.
But you don't know that.
You don't. And you don't know if they're a 642 or a 640 or 39, right? And that could price.
Yeah.
I don't know. I can usually tell someone's credit score just by talking to them. And I'm usually within 5 points.
That's complete and total.
Wow.
baloney.
Confident.
I did it
Well,
all
I'll
the
have a,
time. I would have a
Oh,
game with my
crap.
processor, tell me what the
That is-
credit score was.
no,
And I was always within 5
I'm
points.
calling shenanigans on that 100%. I want to direct everyone back to Brandon, who I'm going to put his contact information on the bathroom wall somewhere because he says 100% of the time upfront borrower pays for the past 14 years for credit reports. Okay,
Huh?
he can do a seminar on how to collect a credit report fee upfront from your borrower since he's been doing it for the last 14 years with no problem. And Jenny says spend it like it's your money, which again, well, depends on who you are, right? Like,
yeah, right. It's
some
all
people spend
relative.
money like
Depends.
drunken sailors, and some
Yeah.
people are super responsible. Not to disparage the drunken sailor by any stretch, of course. So it is. And then we had a whole stream of consciousness from Tony. He said, stuff changes. People used to ride horses to work. It's never been more expensive to procure a loan as a lender. Therefore, it's passed on to the buyer borrower. And again, like bringing the car into it reminds me that this morning I read that BMW is changing the layout on the way that they show information. Now it's going to be all the way across the dashboard, all the way to the passenger. I'm like, why? Like, so sometimes that things cost more and they're not better. And so
Yeah.
if it costs more and it's not better, if you don't have an ROI on whatever you're introducing, and I see this so much in the last few years with all the tech, etc. Oh, here's this new little widget, and what is it doing really? And is anyone really using it? For the 3 people who are using it, great. But the rest of them, it's just another cost, which is added to the bottom line of everything. So
I have a friend who she's the president of her company, and what she has started to do is she puts something in the contract where there has to be a trial period. And if they pay a little bit more for the first 120 days, so be it, but they can back out of that contract.
wow,
Make
good.
sure you do that so that if you're not getting what you were anticipating, your ROI, as you said, back out of it. But if you're not doing something like that right now with your contracts, it's something you really should.
So Jenny said butter and eggs cost more, but they don't taste any better. Dairy was up 51% last report, and fruits and vegetables up 31%. I mean, it is crazy, but yeah, anyway, that's a whole nother thing. So anyway, so Tony was also, well, first of all, he also says, I like your glasses at Audrey. And he said, I also like your glasses at Kevin. So I'm thinking maybe he dropped a little acid this morning before watching the show, but let's just keep going with it because he also said he was wondering if any opinion, if a minimal credit report would ever be something agencies would be open to in perspective. An appraisal waiver seems more crazy to be as that's the collateral the loan is written against. Okay, he was dropping acid, not minimal, more a cheaper option for an abbreviated report. Anyway, bottom line is,
Yeah.
are you below this number? Like, if you're above this number, but again, I think you'd have to abandon this idea that we have the fake idea that we have risk-based pricing and it's all based on credit scores and,
Yeah, I think he's saying like
complicated.
a stripped down version. And if anything, the bureaus are wanting a more robust. I mean, they're talking about, or the agencies are talking about a 2 bureau that they would accept. But in terms of what's included, trended data wasn't included before, and now it is. So they're looking at more information versus kind of a stripped down. So no, sadly, I don't think so. I think, potentially a 2 bureau report, but again, then that would be a 2 bureau report with an additional score model associated to it. So I don't think it would be cheaper or advantageous in that way.
Just a little reminder that Vantage score went up, what, 400% in like a year? Wasn't
Yeah,
that?
it's
Yeah.
similar now to FICO, so it's not
I
it's
mean,
not.
the cost savings is A, non-existent, and B, that, anytime someone sees that they can make a money grab, they're doing it in this economy. And we're seeing it across. Kevin was describing to me a service the other day that someone was providing, and the amount that they were charging for a 1 day is absurd. And so again, like we've all lost our freaking minds as far as thinking what our value is, based on, many, I I was talking to my friend who paid somebody $225 an hour to decorate their house for Christmas. I mean, and they said you can have 6
Yeah,
hours.
and this is not the lights on top of the house.
No,
This is
no,
just
not the
putting
lights. This is
ornaments
like
around the inside of the house.
shit around my house. I was like, what? Okay, A, And then when I was giving her crap about it, I'm like, well, she can only do it a certain part of the year. She can't make a living. I'm like, 225 an hour to decorate a freaking house for Christmas. Are you out of your freaking mind?
Well, it goes back to whoever said, spend it like it's your own money. If you're that person, if you've got the 220 to
Five.
decorate your,
5.
yeah,
Anyway,
yeah.
I just think that we are just in such an odd space where, we're dinking around. Okay, so $130 too much for a credit report, 225 an hour times 6, that's fine for, decorating my tree. And anyway, it's all just so
Hey,
Yeah.
Tracy, I got a question for you.
Sure.
Are the bureau scores getting closer? There used to be a wide gap between one score to the other score because one company was picking up, like J.C. Penney's wouldn't report to all of them, and or I'm making up names, but Macy's might not report to all of them, or Sears, or and now I'm betting that they pretty much all are reporting to them. Am I correct?
Are you naming companies that don't even exist anymore?
Yes,
Yeah.
I am. That way I don't offend anybody.
Really? You can offend.
Service
Although I think I just
merchandise
offended
and
J.C. Penney's because they do still exist.
I know, I was thinking, like, did you guys have like Venture or Kmart? Like those were like around, what are
Yeah, that is.
you can get popcorn. So are you asking if they're getting closer together in terms of what their score analysis is? Or if,
Yes.
so it's in,
And reporting the same data,
yeah,
because
reporting the same data, yes. I mean, there's not, it used to be when I started, it'd be all the Department of Education student loans went to Equifax, or
right.
or if you were on the East Coast, it was more likely to be on TransUnion, something to that effect. But so no, there doesn't seem to be a stretch of, more likely than not, you're going to see each trade line, so that each creditor is going to be reported to all three. The times that you
Right.
didn't, now as of today, the CFPB came out and said that medical collections are no longer going to be
I
allowed
saw that.
on credit reports. So, that was, sometimes you would see a medical collection that would
On
only
one and
be
not on the
one,
other.
or
Yeah.
Mhm. But so, that's going away. So, other than that,
How about judgments? Are they still showing up?
well, there's liens and judgments reports that are separated. There was, they kind of parsed that out before because the bureaus didn't want to be associated with that because there was limited data with judgments. So now, no, you're not really
So
seeing
it's
that.
not included in the score, but it can appear on the credit report.
It would appear on a liens and judgments report if
Okay.
you get that included. As for the kind of score analysis and where the bureaus stand, it kind of does depend on your demographic that you're working with and how big your company is and all of that. But we do dashboards for some of our customers to show them kind of where their scores are overall each month. And it really varies. So some might have a spread. I just brought up like a couple while we were talking. So like I had one customer where their mid score more often than not was TransUnion. But then I had another one whose mid score more often than not was Equifax. The difference between the lowest score average and the highest for one company was 10 points, for another was 30. So it does seem like there's a mix there. I'd have to go, we'd have to go into a deeper dive if our customers really wanted to see why there is such a difference there. And that might have to do with, are they pulling single bureaus more? Are they stopping at a two bureau if they're doing like a cascade or auto upgrade? But, there still is a spread and a difference in how they're reporting. And, potentially this year we might start to see Vantage and how that looks, and the new FICO 10T, and if that changes how things are as well. And if anyone was at MBA, for the first time ever, Vantage and FICO were on the same panel, and it was exciting.
Really?
They hate each other.
Oh,
Really?
It was awkward. I mean, I felt bad for, a friend of mine who's actually the president of our competitor was the moderator, and she did a fantastic job with it. But they were it just basically going back and forth and saying how the other person is doing it poorly and why they're not doing it the right way. Yeah.
Wow.
Yeah.
So much fun. Oh,
On
that
that
would
note, first of all, is there a clip that we could watch of that? Because, you know, for those
I
that are,
wish it was hot.
that's, you
I
know,
mean, you know, credit's
Things
already
started
so
flying, huh?
exciting, but for me, I was sitting there like, ooh, drama. It felt like a Real Housewives of credit reporting. I don't know. It was very exciting.
wow. Okay, so on that note, is there an update to the potential role? No, okay. Oh my
Yeah,
God.
remember when you had me on like 2 years ago
Yeah,
and
yeah,
we
and
did
it was
a
intimate.
deep dive on this? And this is
Yeah.
why last year when you're like, come give me an update, I'm like, the update is there's no update. I mean, there are slight things happening behind the scenes. You know, we're working with the agencies on, you know, providing them with data. We're kind of working again with, you know, FICO and Vantage on the back end, putting together test cases. So things are happening subtly that have no impact to you or to other lenders right now, other than, you know, we're still working on it. There's no timeline of like when this is actually going to happen. I mean, they still have their playbook. Everyone can access that on Fannie. And I brought that up before we got on to kind of look and see if anything's changed. Nothing's really changed other than, you know, there's a few more TBDs rather than actual kind of like goalposts of where they want to be. So, you know, Q4 potentially buy merge, potentially listing other scores, but
Okay. So basically, it's just like anything else. Maybe it happens, maybe it doesn't.
it
We
doesn't.
say,
Yeah.
or here's our projection, but it could change.
Right.
So okay, speaking of
Would
which,
would Vantage ever consider changing their scoring model so it lines up with the other bureaus?
the whole point. It's supposed to be more inclusive. It's not supposed to line up. They're supposed to
Well,
see
it's
more
kind of like
borrowers.
comparing
Come
Fahrenheit and Celsius that you can get them to line up.
So here is what the main argument was, and I'll summarize it for everyone, is that with Vantage, their whole thing is that you're reaching a whole different scope of borrowers. FICO is saying, yes, potentially you are scoring people that previously were unscorable for a reason. And if you give them a score, that doesn't mean that they're going to get a loan. So then you're actually deterring them and making them feel bad about themselves. So you're not doing something, and you know they're citing studies that make this all happen. It
Yeah.
makes sense. It's kind of like you want people to feel good about themselves. Vantage is saying, yeah, so give them the score, let them know it's attainable. And FICO is saying, well, yeah, but that doesn't mean you can give them a loan. If you're going to immediately give someone a score because they opened a credit card, but you have no idea what their spending habits are, that you can't really score them. It's like, good for you, but we don't know if you're going to be late in 2 months or whatnot. So
It's like the client I had that added his utility bill onto his credit score or his credit report and thinking that's what he's supposed to do. And he got turned down by one of the big banks because they rolled that into his ratios. And I'm like, I got fortunate enough along to have him come talk to me. And oh, wait, we can just pull that numbers out of your ratios and now you qualify totally.
well, you can opt in and opt out of those things, right?
Yeah.
So anytime you have, and that makes it questionable too, is that anytime you can have control over what you want to be seen and not seen, that's tricky, right? Because
Yep.
technically you can't unsee things. If you've never seen them, it's a different story, but it does kind of, it becomes a little bit tricky later on.
Well, I think it also is, I'm going to take this all back to where I always go, which is we're here as LOs and we're valuable, way more valuable than pushing a button because we can explain the credit to somebody. Here's your score. Here, you're 2 points away, but if you did this or did that, or you're 100 points away, and if you did this and you did that, like it's literally just reinforcing the value proposition for an LO who has, you know, their head in the game and isn't completely, you know, lazy. And so it is, I mean, again, more work, but more opportunity really. And again, it is the, it made me laugh when you're like, oh, don't hurt their feelings. I'm like, okay, if that's where we are, you know,
Right.
inspire you to be better. How about, you know, it
Right.
help
But
motivate you to do things differently. How about, you know what I mean? Like we just have
it's
got,
hard, but you're talking about, you know, not to go too far into the weeds, but they're talking about a population of people to which they feel like they have been discriminated against because of credit. And so then it does become part of this psyche, I guess. I'm
I
kind of
know.
playing devil's advocate.
And it's credit habits. Like again, like if you're less comfortable with, having a credit card and you don't have any, but you do have, but again, that also you've got to be careful because when we were in DC and they were first talking about this and they started saying that there was a proposal by some legislators who of course have no idea to put everybody, it would just nobody would have a choice. Everybody's utilities, everything's on your credit
Oh,
report.
yeah.
And I mean, that would be a disaster for some of our 800 credit score borrowers because they know that they can pay their cable bill late or they hate their internet provider or whatever, and they're, sticking it to the man by not paying on time. And then all of a sudden this comes out of nowhere. And then, yeah.
Oh,
So bottom line
Yeah.
is,
I'm that girl. I mean, I really like a couple of times have just been like, oh, I forgot. And then I do like auto pay now. But like a couple of times I'm like, oh, the water bill. I don't even think about it. I just see it come up or, not
Yep.
gas. And I'm like,
Then they send you a notice and turn it off. Oh, well,
I
I
may
still have
have had
5 more
that
days.
before. And it's not like I'm a delinquent. I just don't think about it. Or who knows? We're all weird in our own ways. But yeah, if I didn't
yeah,
know that something was going to be used against me, then
right.
I have different habits around it. So yeah, that would be probably a scary thing.
Yep. So it is always interesting to even contemplate all this stuff, and
Yeah.
there's such controversy around whether or not we should even eliminate the not mortgage, the medical debts from credit reports. But then we were told that such a small percentage of people have that as an issue, and it really doesn't, from what people have seen, it doesn't reflect whether you pay your bills overall or not.
Although,
And
although the medical thing is really important. I was listening to someone saying that if you go to a hospital, make sure you don't pay your medical bills with a credit card. Because if you pay the medical bills with a credit card and you don't pay the credit card, that shows up on your credit report. But
kidding.
if you just work out a deal with the
Oh,
hospital
right.
and
Yeah.
I will pay you, $50,000 for that X-ray, and then you don't pay it, that doesn't show up on your credit report, and you're good. But
Yeah.
if you give them your credit card information, you're in trouble.
Okay, thanks, Captain Obvious. If you pay with your credit card and you don't pay your credit card, you're screwed. We got
Yeah.
it. You're good.
Well, that's a temptation. People would think about it. Oh, I'll just put it on my credit card. Oh,
Yeah,
wait a minute, I can't make these payments. Now they got a problem.
yeah, that's true. Okay, I just wanted to talk for a moment about a headline that, and actually it was pointed out by our friends at MBS Highway, but there was an article written by Diane Oleg, who is with CNBC, and it says the housing market is heading into 2025 with a worrying supply trend. And she was talking about the inventory levels that have gone up, so fast and so high. And I just want to remind everyone that they are still 32% lower than pre-pandemic levels. And there was also a reference in the article, and they were talking about these places that have been on the market for more than 60 days. And oh my God, oh my God, oh my God. And then there is also a quote from a realtor who said a lot of the listings in the market are either stale or uninhabitable. So it was like, so either the properties are so bad that you can't even live there, so no one's buying them, or also there's an issue with the pricing, which we've talked about numerous times on the show, which is, people, I just bought it 3 months ago for, 730 and now I'm going to sell it for 850. Maybe if you're lucky, but don't
We
be
ran into
surprised.
that one a couple months ago with somebody down in
So
Florida.
anyway, so don't buy into the headlines is my last thought today. And again, the credit, it's a big we'll see, but maybe think about charging your clients upfront, having them pay for it upfront so that they can absorb that hit and maybe they'll be a little more loyal to you. And if we can get Brandon on here to do a little seminar on how to frame that to your borrowers, maybe that'd be worthwhile. with all that being said, Happy New Year, everyone. And thank you so much, Tracey, for spending time on your birthday and coming to share with us what you're seeing out there, which is really valuable. And we are really looking forward to a much better 2025. I mean, we said it last year, and for a lot of us, it was way better. I think that's going to happen again this year. And just get on board because you can be part of that if you're not sitting around waiting for the rates. So, with that being said, Tracey, we love you. Happy birthday.
Love you. Thank you guys. I was gonna say,
Hey,
nothing means
everyone.
business. Like if it doesn't go the way you think, nothing means business more than a shopping cart at a liquor store. That's what gets you through.
Oh my goodness. That's right. That is always plan B. So thank God for that. And with all that being said, go get a loan. Go close a loan. They're out there.
We'll
They're
get
waiting for
two.
or get two. Let's
Yeah.
start with one. All right, kids. Have a great week.